U.S. market is behaving a lot like a heavy-duty truck driving down the highway, but with one foot absolutely slamming the accelerator.
Oh, yeah.
Which is, our domestic artificial intelligence growth. But then the other foot is just aggressively riding the brakes.
Right, that intense geopolitical energy squeeze we're seeing.
Exactly. So if you're an investor trying to read the dashboard today, you're seeing severe geopolitical escalations on one monitor and then these multi-billion-dollar tech breakthroughs on the other. So welcome to the show. I'm your host and practitioner.
And I'm your co-host and analyst.
And today, somehow the accelerator completely overpowered the brakes. U.S. equities pulled off this incredible tech-led recovery. They completely defied the gravity of a raging energy squeeze and, rising 10-year Treasury yields.
It was wild to watch.
Totally. So for our market conclusion for Tuesday, July 21st, 2026, we saw S&P 500 futures, the ES, recover from an incredibly ugly early low of 7,473. And they actually managed to settle up at 7,541.25.
Yeah, and that intraday swing is just remarkable. It really tells you that there's a distinct fundamental logic behind how different asset classes are digesting all these cross currents.
Right, and that is exactly our mission today. This deep dive is going to break down, how markets absorbed the global energy squeeze, these sudden new trade tariffs, and what I can only really describe as a massive tech and nuclear energy mashup.
It's a lot to unpack.
It really is. But before we jump in, just a quick reminder that this show is for market context and discussion only, and is not personal investment advice or an investment recommendation.
Right, exactly.
So with that framework set, let's open session one. What set the stage before the U.S. session today?
Well, to really understand today's U.S. price action, you have to remember the carryover narrative we've been tracking all week from prior sessions. We were dealing with this massive unresolved tension in the macro environment.
The inflation tension, right?
Yes. So on one hand, you have that cooling June inflation data. And normally, that gives equities a massive green light to rally.
Yeah.
Because it suggests the Fed can finally ease up.
Right. But on the other hand, you have the ongoing direct U.S.-Iran conflict, which is threatening the Strait of Hormuz.
Exactly. So the market is desperately trying to figure out the math here.
Yeah, if higher oil prices cascade through the supply chain, does that force the Federal Reserve to remain restrictive, which would completely wipe out that June inflation progress?
Precisely. And that tension really exploded into the foreground because the overnight developments, everything that happened before the U.S. Open on Tuesday were, frankly, alarming for energy markets.
Alarming is probably an understatement.
Yeah, true. Over in the Strait of Hormuz, commercial traffic just collapsed to a 3-week low. Yemen's Houthis threatened to use anti-ship missiles against, any vessel violating their blockade.
Okay, let's unpack this for a second because the logistics of that threat are staggering. We aren't just talking about delayed shipments of consumer goods anymore.
No, not at all.
That threat caused at least 2 massive oil tankers loaded with Saudi crude to make sudden U-turns in the Red Sea overnight. And, when a supertanker makes a U-turn, you are adding weeks of transit time and just millions of dollars in insurance and fuel costs.
It's a massive physical disruption.
Right. And it wasn't just the Middle East, was it?
No, it wasn't. Up the Black Sea, the Caspian Pipeline Consortium completely halted its intake of Kazakhstan oil.
Wow.
Yeah, and this happened following a series of drone attacks on tankers in the region.
So you have 2 of the most critical energy choke points in the entire world under active simultaneous threat.
Exactly. And what's fascinating here is how the physical commodity markets responded to that dual front disruption. When you cut off the Black Sea pipeline intakes, you are introducing an immediate physical disruption to non-Middle East oil supplies.
It creates a multiplicative shock, not just an additive one.
Right. So Brent crude futures reacted violently overnight. They dipped as low as $88.33 as traders tried to assess the damage before surging all the way up to $91.41 per barrel.
Wait, I actually have to stop you there and push back a little on the prevailing floor narrative.
Oh, really? Go ahead.
Because everyone on the trading floor is treating these blockades like they are unpredictable, natural disaster, like bad weather rolling in that you just have to wait out.
Yeah, that is the standard view.
But if you look at the timing and the coordination, this feels incredibly calculated. We've discussed this before. We're looking at geopolitical escalation as game theory brinkmanship. Aren't they explicitly weaponizing the inflation narrative to force a diplomatic ceasefire?
Honestly, that is a highly credible way to view it. And frankly, it's a much more accurate lens than the whole natural disaster theory.
Right.
Yeah, by targeting the global inflation nerve center, which is energy transit. These actors are exerting maximum leverage on Western economies. They know Western incumbents are, well, highly sensitive to consumer price index spikes right now.
And it is working, at least on the European side of the equation. Not only is it calculated, but it is hitting the West exactly where it hurts most, which is the credit cycle.
Oh, absolutely.
Look at what happened in Europe today. Right at 4 a.m. Eastern Time, the European Central Bank released its Q2 lending survey.
And that survey perfectly illustrates your point about the weaponization of inflation. The data showed Eurozone banks aggressively tightening their credit standards across all corporate loans.
I mean, imagine you are a European bank, you are looking at your corporate clients, and you see their energy input suddenly skyrocketing because of these blockades.
Yeah.
You have to pull back lending.
That is exactly the mechanism at play. The banks explicitly cited these exact geopolitical and energy price concerns in the survey.
Wow.
So you have a tightening credit cycle in Europe. When banks tighten standards, it slows down the velocity of money. Businesses can't get the capital they need to expand, which poses a real immediate risk to corporate capital expenditures across the entire Eurozone.
Yeah, that makes sense. So to summarize the overnight anxiety for everyone, we had severe calculated energy supply disruptions choking global shipping lanes, pushing Brent crude over $91, and causing European banks to slam the brakes on credit.
Pretty grim picture.
Very. That was the picture before the sun even came up in New York. Which brings us to session 2. What moved markets during U.S. trading hours?
Well, the first major driver out of the gate was intense military escalation and, crucially, the staggering fiscal cost attached to it.
Right.
We saw direct military exchanges. Iran's Revolutionary Guards launched missiles hitting a U.S. radar facility in Kuwait. In response, President Trump issued a severe warning that the U.S. would heavily strike Iranian nuclear operations in the Pickaxe Mountain area.
And the Iranian Joint Military Command immediately countered, right? They vowed to target all U.S. regional interests if their nuclear sites are hit. But let's look at the financial plumbing of this escalation.
Yes, the costs.
Because at 2:28 p.m. Eastern Time, Defense Secretary Hegseth went before a Senate panel. He asked for an urgent $67 billion supplemental funding bill. And he just casually dropped the fact that this conflict has already cost the U.S. $37.5 billion.
And this raises an incredibly important question about the bond market's capacity to absorb these shocks. Like, how does a government finance a $67 billion emergency spending bill on top of existing deficits?
You issue more debt.
You issue more debt, exactly.
So if you are holding long-term U.S. debt right now, you are essentially demanding a higher premium. You are looking at Secretary Hegseth asking for another $67 billion, and you know the Treasury is going to have to just flood the market with bonds to pay for it.
That is the exact dynamic.
Yeah.
The market immediately had to digest the dual threat of energy-driven inflation and heavy new U.S. debt issuance.
And supply and demand kick in.
Right. Basic supply and demand dictate that when the supply bonds goes up, their price goes down and their yield goes up. That is why we saw the 10-year Treasury yield get pushed all the way up to 4.628%.
Which is huge.
It is. Simultaneously, West Texas Intermediate Crude WTI pushed to an intraday high of $85.03, eventually closing at $84.51. So the bond market is just punishing the long end of the curve because traders refuse to hold long-term U.S. debt in an inflationary high deficit environment without a massive yield premium.
But, you know, here's where it gets really interesting. You have war, you have inflation fears, you have spiking Treasury yields, and yet the U.S. equity market practically shrugged it off.
Yeah, they barely blinked.
Why? Because the narrative completely flipped when we got this incredibly optimistic economic counter-narrative from the administration.
Yes, the domestic economic data provided a massive buffer. At 12:15 p.m. Eastern Time, Treasury Secretary Bessent came out and stated that 3% GDP growth is a completely reasonable expectation for the second half of 2026.
And a massive poll of economists backed up that domestic stability, showing they overwhelmingly expect the Fed to just hold rates steady at 3.50% to 3.75% next week. Like, they aren't predicting panic hikes.
Right, the equity market is stubbornly clinging to this Goldilocks scenario, the idea that the underlying U.S. economy is just so robust, so insulated, that it can absorb a foreign war and an energy shock without falling into stagflation.
I have to challenge this Goldilocks assumption, though. I mean, is this explanation just terribly mistimed?
How do you mean?
Are we just looking at current consumer resilience that is merely delaying the inevitable? We know how the economic gravity works here. We've talked about central bank demand destruction against supply inflation.
Right.
The Fed is holding rates high to intentionally crush demand because global supply is constrained. That financial pain hasn't fully trickled down to the average consumer yet. But the longer oil stays at $85, it has to eventually, right?
Your skepticism is exactly why the yield curve is behaving the way it is. The equity market is trading on today's 3% GDP growth projection, but the bond market is pricing in the long-term cost of this resilience.
Yeah.
If the Fed refuses to cut rates because oil is stuck at $85, that prolonged high-rate environment will eventually erode corporate margins and household purchasing power. But for today's trading session, equity algorithms just decided to focus strictly on the growth projection.
And they also managed to look past some severe trade and geopolitical cross-currents. Let's compress these because they came fast and furious, and the market's reaction was fascinating.
Definitely.
First, tariffs. The U.S. announced a 25% duty on Canadian imports taking effect in 30 days, plus a 50% tariff on specific items by August 19th, citing bias in dairy and alcohol trade.
And Canadian Prime Minister Carney immediately pushed back, stating this violates the USMCA and promising to evaluate all retaliatory options.
But despite the very real threat of a trade war with one of our largest trading partners, S&P 500 futures stayed totally resilient. Why didn't the market panic over Canada?
What's fascinating here is how the market categorizes threats. Traders seem to view the Canadian tariffs as a negotiable skirmish rather than, like, a structural trade collapse. Yeah, if you dig into the details, energy and critical minerals were explicitly excluded from the duties. Because the core industrial supply chain was protected, the market priced it as political posturing rather than economic destruction.
But the tensions with China were a completely different story. At 12:09 p.m. Eastern Time, US Treasury and trade officials dropped a bombshell. They warned they actually found American watermarks on Chinese AI models.
Yeah, and for you listening, a watermark in an AI model is essentially a hidden cryptographic signature embedded in the model's neural network weights. It basically proves where the foundational training data or architecture came from.
And finding those watermarks implies massive intellectual property theft. So the U.S. is now threatening targeted sanctions against any open-source AI models utilizing that stolen IP.
This is a major escalation. Sanctioning open-source AI platforms could completely fracture global tech supply chains and isolate cross-border research. But again, the U.S. market just absorbed the blow.
No, I mean, you have a brewing tech war with China and a trade spat with Canada.
The market absorbed the AI sanctions because investors basically believe U.S. tech has an insurmountable moat. The domestic AI growth engine is viewed as too strong to be derailed.
Right.
And on the energy side of the portfolio, the anxiety was offset by massive capital flows securing future supply. At 3:16 p.m. Eastern Time, Iraq signed $200 billion with a B in agreements with U.S. energy companies.
That is just a staggering amount of capital. And those agreements are designed to boost future oil production and gas capture. By securing a massive long-term pipeline for domestic energy giants, it effectively sedated the panic in the energy sector, which helped the energy ETF XLE rise to $58.50.
So you have this fascinating dynamic where long-term structural deals are cushioning the blow of short-term geopolitical shocks.
Yeah. So to summarize the U.S. session for you, we had traders masterfully balancing intense, expensive geopolitical and military risks against robust domestic growth projections and massive overseas energy contracts. It was a high-wire act, but the market didn't fall, which leads us perfectly into session 3. What is the corporate events recap for today, and what should we watch next?
This is where the tech sector really stole the show and drove that late-day recovery. During U.S. trading hours on Tuesday, right at 11:01 a.m. Eastern Time, we saw a massive convergence of technology and infrastructure hit the wires.
The big AI push.
Exactly. First, on the silicon and software side, NVIDIA announced that customer testing for its next-generation Vera Rubin AI platform is proceeding exactly on schedule. Simultaneously, Google unveiled its new Gemini models and confirmed it is beginning Gemini 4 pre-training.
Okay, let's unpack this, because building these massive AI models isn't just a software coding problem anymore. It is a physical world problem. It requires vast data centers, cooling systems, and just megawatts of electricity.
Tons of it.
It is an energy crisis problem. And that is exactly how these tech giants are pivoting, isn't it?
Precisely. To power this staggering amount of artificial intelligence capital expenditure, this AI capex the tech industry is literally turning to the atom.
Wow.
The sheer energy density required by these next-generation chips means traditional grid infrastructure simply can't keep up. So nuclear developers Oklo and X-Energy officially joined a $200 million White House-backed effort to dramatically speed up the deployment of small modular nuclear reactors. And this initiative is specifically targeted at powering AI data centers.
So what does this all mean for the indices? Well, the market absolutely loved this blueprint. NASDAQ 100 futures closed up at 29,282.75. Investors see a viable path to keeping the AI growth engine running without, browning out the national power grid.
Right.
But here is the critical under-the-hood metric I was watching all day. High-yield corporate debt, tracked by the ETF HYG.
Ah, yes. It remained remarkably stable, closing at 79.65.
Exactly. This stability perfectly illustrates a theme we know well. Private debt as hyperscaler AI capex cushion. These mega-cap tech companies have such deep, structured access to capital that they are essentially insulating the broader credit markets, even while Treasury yields are spiking. The capital is flowing so heavily into AI infrastructure that it's acting as a shock absorber for high-yield debt.
And we connect this to the bigger picture. It raises an important question about the physical limits of the digital economy. The fact that Google and NVIDIA's roadmaps are now inextricably linked to the regulatory approval of small modular nuclear reactors, it shows that the AI bottleneck isn't processing power anymore. It is electricity.
It's all about the grid.
By securing these nuclear partnerships, they are signaling to investors that they can overcome the grid constraints that threaten to derail the AI supercycle.
With NVIDIA and Google officially teaming up with nuclear developers, our tech portfolios are literally going subatomic. I guess that is one way to beat the Middle East oil squeeze, right? Just plug your large language chatbot directly into a small modular nuclear reactor.
It's one solution.
I'm just hoping out loud here that our stock screeners won't require a hazmat suit by tomorrow's opening bell. But hey, let's raise a glass and toast to the hope that tomorrow's trading is a bit more stable isotope and a lot less critical mass.
I think that might be the most accurate, albeit terrifying, description of market sentiment I've heard all week.
I'll take it. So, before we wrap up, let's look ahead. Strictly based on our main sources, what are the immediate catalysts we need to watch for in the next 24 hours?
We have 5 major events on the radar over the next 24 hours. First, overnight, we have to closely monitor the Strait of Hormuz and Red Sea security headlines. Any fresh military disruptions or, actual missile strikes on vessels there will instantly reprice crude oil.
Which then bleeds into inflation expectations and ultimately forces Treasury yields higher. It's all connected. What's the second event?
Second, at 11:35 p.m. Eastern Time tonight, Japan is holding a 40-year JGB, or Japanese government bond, auction.
Let's explain why that matters to a U.S. investor.
Sure. We need to watch that auction for global duration spillover. If Japan offers higher yields on their 40-year bonds to attract buyers, Japanese institutional investors might pull their capital out of U.S. Treasuries to invest at home, where it's safer from currency risk.
Right.
That spillover lowers global demand for U.S. debt, which forces our yields up even further.
It's always fascinating how a late-night auction in Tokyo can dictate mortgage rates in Ohio. Number 3.
At 2 a.m. Eastern Time on Wednesday, the UK releases its June CPI and core CPI data. The Bank of England is facing similar stagflation pressures. An inflation surprise there could move global interest rate expectations ahead of the U.S. trading session.
4th.
At 10:30 a.m. Eastern Time Wednesday, we get the EIA Weekly Petroleum Status Report. Given the massive supply disruption panic we saw overnight in the Black Sea and the Red Sea, the raw data on U.S. crude and gasoline inventories is going to be hypersensitive. The market wants to know exactly how much buffer the U.S. has in physical storage.
Makes total sense. And the final catalyst.
Finally, number 5. At 1 p.m. Eastern Time Wednesday, the U.S. Treasury is holding a 20-year bond auction. Given Secretary Hegseth's $67 billion funding request today, dealer take-up at this auction will be a massive test for long-end demand. Will buyers step up, or will they demand an even higher premium?
So, returning to where we started, we are still driving that heavy-duty truck with our feet slammed on both the gas and the brakes, but for today at least, the nuclear-powered AI engine kept us moving forward.
It did.
Before we go too on this, we spent today talking about how tech giants are essentially buying up nuclear power to build superintelligences. But if artificial intelligence becomes the primary insatiable consumer of global energy, are we rapidly approaching a future where data centers, not everyday citizens, dictate the baseline price of electricity? Think about what that does to structural inflation a decade from now.
It's a huge question.
It really is. We'd love to hear how you are navigating this storm. Drop a comment and let us know how you're positioning your portfolios amid this unprecedented nuclear AI and geopolitical crossfire.